As a 17-year-old, I significantly outperformed professional money managers. The key to this is not day trading. I did it through investing and I have a return of over 80% with some new positions that distort the returns. The key to that is actually information, is the perspectives of professionals but also normal retail traders who are advanced, focused on stocks and continually outperform the market. I've helped engineering students, people over 20 years of age. I have had the opportunity to look at how the best retail investors I know of online play. Most people try to chase the big players. Most people try to get ahead of them. Larry Sweejo, for example, in this book, The Quest for Alpha. Alpha, in terms of investing, trading, and financial markets, basically, is how much you're above or below the market benchmarks. As I said before, the key is information, and I don't mean short-term information. Earnings of a company or the latest sales results, literally anything that is expected to move a stock price based off sentiment and pure reaction rather than an analysis. I'm in the top 1, maybe 0.1% of the whole stock market in terms of returns, and I haven't bought any of the big stocks like Nvidia, Google or anything. I actually wanted to bet on something smaller, something safe, but something that has better growth prospects than the Magnificent Seven. Now, you may be thinking, how do perspectives really matter that much? Most people try to chase the big players. Most people try to get ahead of them. They try to find the most relevant or recent information and are just waiting for the big money to quickly pile in. That's not what we do. It's kind of similar, but way different. I mean, imagine you're a newbie. Imagine going to the black slope, trying to catch up to the big players, the most advanced people with the most knowledge, the best algorithms, and the best people under their management. Instead, what we're trying to do is to find solid companies that have been beaten down, that have mostly a market cap below 50 billion, because that's where undervaluation can come in, because people don't bother looking at companies like that. We're trying to position ourselves on the mellow runs, on the firms that have established themselves, that are profitable mostly. Once you're more advanced, you can speculate on 1 or 2 stocks with smaller amounts of money. You're not gonna keep accelerating 9.8 meters per second squared constantly off a blue run. What we're trying to do is to ski down and just wait, initiate our positions, build them out. In the most basic terms, we want to wait for the big players to see an opportunity in the company that we own and that it has been undervalued, it has been misunderstood, and then ski along with them. Thanks to air resistance, they're not gonna keep accelerating constantly, not at the same rate at least. So if we weigh our portfolios percentage-wise, because in absolute terms you're not gonna get bigger than them mostly, we might have enough weight of our portfolio in that company to actually get ahead of them return-wise if the company runs, once they start buying. I'm not an expert of finance myself. I know stocks and some things that kind of influence stocks, some basics of a bit of macroecon, microecon, but then also bonds and stuff. But through literally owning companies, giving them funds by buying shares, or investments paying off because of the appreciation of the company itself, the earnings and the growth rates of a company appreciating, but then because of the fact that others want to be part of it, and then the price goes up. In the most basic terms, the PE ratio goes up. I will show you how to make money, and it's not the way you think.